Welcome to the FICO Series. This is the first of 5 videos. My name is Raoul Cannon. I'm the author of $10 Credit Repair, the Ultra Edition, Volume 4, which you can click and get in the link. And I'm also the creator of this channel. And like the book, this channel is to provide you with all the information you need so you can understand your credit. I'm a former bank underwriter with 25 years in credit repair. Now, FICO models. You may be saying to yourself, what is a FICO model? Well, we're all aware of one FICO model, and that is the Vantage score. Who's the Vantage score? What is that? When you look at Credit Karma, Credit Sesame, or CreditWise, and you get your credit score from there, that is your Vantage score. Your Vantage score is not used by any lender and is typically 50 to 120 points higher than your FICO score. Your FICO score is what is used by lenders, and there's a different FICO model depending on the industry and where that lender is operating. So if you're applying for a home or a car or a credit card, there can be 3 different scores. That is correct. 3 different scores. Not because your credit has changed, it's because each FICO model addresses certain negative items with a heavier weight than the other FICO model. So typically, to give you an example, when you apply for a credit card, you may have a 700 credit score, but if you have a late payment with a credit card within the past 2 years, they will actually show a lower credit score than your FICO 8. When you pull your FICO from Experian, Equifax, or TransUnion, they use the FICO 8 model. Bank cards use the same model, but they place heavier weight on late payments and charge-offs that originate with a credit card. So first, this is what Credit Karma uses. That is your educational model, Vantage 8. No lender uses that credit score. So when you look at your Credit Karma, Credit Sesame, or CreditWise credit score, understand no lender uses that credit score. Now, lenders use FICO models. Each FICO model is designed to provide that lender with the best assessment on if you're going to pay your bill. So let us go through what FICO models. Now, mortgage companies use the FICO 2, 4, and 5. Those models are the oldest and the strictest FICO models. So when you go to apply for a mortgage, your score may appear to be lower because those models are old. And give you an idea, say you have rent reporting and you've paid money to have your rent reported onto your credit report, your streaming services, your utilities. When you apply for a mortgage, those additional points that you may have gotten and payment history that you got from using that service does not count. So you use that service and it took your score from a 640 to a 660. When you go to apply for a mortgage, they're going to see probably around a 620, depending on how strong your FICO score is, but they will not see your rent payments. They're not going to see your streaming services. That's called self-reporting. Those FICO models do not pick up on self-reported credit or trade lines. So now, what is important to that particular model? Your true credit history, especially installment loans, and the length of your credit history. Now, the next model is a score you are familiar with, the FICO 8. When you pull your credit reports from Experian, TransUnion, and you actually get your real credit report, not by one of their alternative arms like CreditWise or Credit Sesame, that is your FICO 8 score. Who uses your FICO 8 score? Your FICO 8 is when you apply for credit cards and personal loans. Now the credit card companies use a FICO 8 model, but it's weighted differently, as I said previously, on a late payment for a credit card or a charge off that originates on a credit card. Your credit score can be lowered if you have one of those, even though you may have a 700. Now, the auto, when you apply for an auto loan, the lenders use FICO 2, 8, or 9. Now, even when you apply for an auto loan and you have a great credit score, what impacts you on your auto loan credit score, any late payments that you made or defaulted on a previous auto loan. So, if you have a high credit score, but previously you had a late payment or a repossession, your score is going to reflect lower when you apply for that auto loan. Now, bank cards. Now, here's a tricky thing. Bank cards, when you go for a Visa, MasterCard, or American Express, they use FICO 8 or FICO 9. FICO 9 is more advanced, so it does take into consideration some other alternative credit. So maybe if you had some rent reporting, they will take that in for some credit card companies because they can still use FICO 8 and have it weighted, meaning they have placed additional weight on late payments. Anything that originates with a credit card that is negative will draw your score further down, even if it's 2 to 3 years older. Now, FICO 10. Now, this is trending data. This FICO model is designed so they can anticipate a default, they can anticipate a repossession or foreclosure, so it uses trending data. What is trending data? They actually take into account if you have a firm or any of the buy here, pay later credit products. So in this model, that can actually hurt you because now it looks like you have the inability to stay within your budget and your current credit arrangements. So if you have a firm and you have Klarna, previously they only deemed your credit when you had a collection because they didn't even show up in any of the older FICO models. In FICO 10, it does pick up trending data. So if you're out and you decide you want to buy something and put it on installments for 4 payments, understand in the next few months when more banks adopt that FICO model, that can actually hurt you when you're going to apply for new credit. Now, these are all the FICO models. And as you can tell, there are a lot of them. So your credit score is not just one score. It depends on what you are applying for. Also, when you go to apply for, say, a home, there's a different way to build your credit as opposed to when you apply for a credit card, and there's a different dispute method you need to take when you're applying for a home. You want to make sure certain things are removed so you have a better chance, and those things would be anything that they place additional weight on. Now, I'm going to go into detail on each model in following videos, but I want to show you here. Look at this score. It's 690 here, 645 here, 710 here, 725, 668. Depending on the FICO model used, your score can appear in one as a great score and somewhere else not great, where you get decline. Now, when you are trying to repair your credit, for auto loans, you want to always focus on any repossessions and have those deleted, any late payments, any high credit card utilization, and any charge-offs. Now, when you are doing a mortgage, any collection over $100, you want to have that removed. Any late payments within the past 24 months, you want to focus on that. High utilization, you want to get your utilization down. Also, charge-offs. Now, when you're looking for premium credit cards, you want to get rid of late payments, high utilization, charge-offs, and any new derogatories. So if you notice, each one has a different attack plan when you're going to apply for your credit based upon what you're looking to purchase. So if you're looking to purchase a home, your credit repair strategy is going to be totally different for someone who's looking to purchase a car. Your credit repair strategy is going to be definitely different for somebody looking for a premium credit card. Because you can actually get premium credit cards and still not get approved for a home because they're looking for two different things, and vice versa. So make sure you follow, subscribe, because I will go into detail in each video. I will drill down further into that particular category on what you need to focus on. So I'm glad you're in. Make sure you subscribe and make sure you tune in to the next, where I will cover mortgages and how to focus on getting the best credit score possible so you can get that home you're looking for. Thank you.